Hi, if value investing only focuses on undervalued stock prices and higher yield opportunities, it's easy to fall into a value trap, which can lock up your capital. We share ways to avoid value traps, allowing you to invest in value with peace of mind. If you enjoy my videos about investing in US stocks, please like and share my videos and subscribe to my channel. Thank you. We'll talk about 5 key points today. 1. What is a value trap? 2. Identifying value traps. 3. Differences between value stocks and value traps. 4. How to avoid value traps. 5. The best value stocks to invest in now. A value trap is a stock that seems cheap on the surface, often because its PE ratio is lower than that of competitors, leading to misleading perception of being undervalued. In reality, the company could be struggling with operational issues, causing a long-term downturn in its finances. Common types of value traps include obsolete industries due to technology. These are companies that gradually decline after disruptive technologies or business models emerge. Kodak thrived in camera and film industry during the 20th century. However, with the introduction of digital cameras and smartphones, the traditional photography market was completely disrupted. As a result, Kodak slowly moved towards bankruptcy. Businesses that are ousted in a sector by a leader. Netscape Communications launched Netscape, the first web browser for the mass market. In 1995, it briefly held a dominant 75% share of the global browser market. However, after Microsoft established Internet Explorer as the default browser for Windows, Netscape's market share quickly shrank within a few years, ultimately leading to its acquisition by AOL. The danger of value traps lies in the misconception that investors can acquire high-quality stocks at low prices. However, as they continuously average down their stock costs, the value of their assets keeps diminishing. We can identify value traps using a few common signs. The company operates in a declining industry where the overall market is gradually shrinking, resulting in a continuous decline in profitability. The company's technology is being surpassed by competitors, resulting in a decrease in market share. The company is accumulating debt in an attempt to regain market share, which is causing a financial crisis. While both value stocks and value traps appear to be opportunities with low PE ratios, they have several significant differences. Value stocks may experience price declines due to short-term market fluctuations or rumors, but a value trap occurs when a company's fundamentals deteriorate, leading to losses. Value stocks typically maintain or grow their market share over the long term, whereas value traps consistently lose market share. Value stocks possess stable profitability and cash flow, while value traps continually borrow to sustain their expenses. Value stocks can afford to wait for market recovery, while value traps can only struggle to survive. To avoid value traps, there are several key tips. Conduct a thorough fundamental analysis of the company to ensure its financial health is sound and that there hasn't been a sudden increase in massive debt. Evaluate whether the company's technology is being replaced or if its competitive advantage has diminished, leading to a gradual decline in market share. Additionally, gather information about the management team's experience to ensure the company has competent professional managers. The value stock list identifies fundamentally and technically bullish stocks from thousands of high-performing companies in the market. We use long signal days to filter stocks that are just about to rise. The smaller the long signal days, the more recent the bullish trend is. We can also choose stocks by sorting the dividend yield. Since we pre-select the value stock list for high-performing companies, simply picking those with the highest yield will ensure a steady stream of dividends accumulating passive income. Combining the long signal days and dividend yield, we can identify the best value stock opportunities right now: D, HR, WTRG, and UMBF. Among these, WTRG and UMBF stands out as dividend aristocrats, having increased their dividends for 34 and 32 consecutive years. By purchasing WTRG and UMBF, you can enjoy a steady stream of dividend income. Now that you know how to avoid value traps, you can use the list of value stocks to find high-quality stocks to hold for the long term.